Yeah, so we talked about seller financing a little bit. So that's when you're buying a property. It's typically somebody who has a lot of equity in the property. That's why somebody's owned the property for 20 or 30 years, and they don't owe 150,000 bucks on a $200,000 house. They might owe nothing on the house, or maybe owe 25,000 bucks. If you see somebody who has a lot of equity like that, they're potentially a candidate for seller financing. Those are that's the best candidate. So that's option one. Private loans, we talked about a little bit about, like my professor who has a self-directed IRA or has a 401k, or there's all sorts of people who have 401ks or IRAs from an old job, and they don't realize that they could actually transfer that over once they left their job to a custodian who allow them to self-direct it. So for all of you out there, if you want to build sort of your own access to your own bank of funds, you've got to educate people. You have to go talk to your friends, talk to your family, you got to be a little careful with family on borrowing kind of retirement accounts. But if you talk to friends, investment friends, go to your local real estate meetups. If you find people there who have 100,000 bucks in their IRA, it might be sitting there and they can't loan it to themselves. That's one of the rules. You can't loan that money on your own deal. But if they met Bradley, if they met Drew, and they said, and you showed them a deal like I did with my professor, here's a deal where I'll pay you 6% interest for 5 years, and it's going to be a rental property for me, and I'll buy it. I'll pay you interest every month, and then we'll go from there. You could show them how that could be a really good deal for them, and how they could get an above average interest rate. They can get payments over time. I have some of my private lenders who are interested in that kind of deal. That's more what I do now, where they'll do just a simple interest rate, 6% interest. I actually do like a 15-year long loan instead of a 5-year. Like I want to get a little bit longer. But early on, I had to do 1 year, 2 year, 5-year loans just to get the kind of comfort level with them. But that's my kind of deal right now. But in the beginning, if you're flipping houses, or if you need to buy that fourplex that I bought, you might need to pay somebody 8%, 10%. You might have to pay a higher interest rate in order to kind of get over that hump of trust, so that they know you're for real. And I think it'd be worth that. Like if you can afford to do that early on, like that extra interest you have to pay to build a relationship with that person and demonstrate what you can do, could be worth it. Because what happens over time is you demonstrate you can perform, and those same people you pay 10% interest to, over time will start lowering their interest rate. They'll say, okay, I'll do 8%. Okay, I'll do 7%. I'll do 6%, because your riskiness to them starts going down once you've demonstrated what you can do. And so that's private lending in a nutshell. It takes some work, takes some relationships. You got to go out and meet the people, but it takes some education. The more you learn about it, and you can hold their hand a little bit and teach them how to do it, you're adding a lot of value to those private lenders. So that's two. Another tool in your tool belt is commercial loans. So I've used those a pretty good bit. And a commercial loan, there's all sorts of different sources of money out there for commercial loans, and it's kind of a catch-all phrase for just all sorts of different banks, commercial lending departments of like national insurance companies, things like that. I typically go to my local bank where I have my banking accounts. I happen to bank at First Citizens Bank, which is kind of a regional bank. And I've built a relationship with them, with the local commercial department. And this is not the people who set up your checking accounts. These are the people who are upstairs or in another room, and they loan money to businesses to lease their building, or to buy a building for their business, or to people like you who are landlords who are buying properties. And the benefit of those loans is kind of like a private loan, in that you get a relationship with a person who can make a decision right there in the bank, instead of having to go like on an FHA loan or something like that, where they have to do an underwriting somewhere else. I like that. It's a real person making that decision. The downside of it is the commercial loans, the terms of those are not as good. Like the interest rate could be 3%, 4% today, which is really good. But then they'll have a 7-year loan or a 5-year loan, meaning whatever you owe in 5 years or 7 years, you got to pay the whole balance of it at that time. And that's a really risky thing if you have a bunch of those, because what happens if 5 years from now we're in the middle of a great recession and you can't refinance those? And so you got to be thoughtful about that, of not loading yourself up with too many obligations where you have to come up with 150,000 bucks on 3 properties at one time. That's really difficult. If you can't assume that you could do it at all the time.
Yeah.
And so that leads us to the last one's more conventional financing, which a lot of your listeners probably are more familiar with. Going to the lending department of your bank, or to a mortgage broker, getting 20% down, or 5 or 10% down loan, 30-year fixed, 20-year fixed, maybe an FHA loan like a Federal Housing Administration, or VA loan, which is a Veterans Administration. Like, those are amazing. Like if you can do those loans, those are really awesome. Low interest rates, long term. The challenge of those is when you're buying a property and it's a really good deal and it needs a lot of work. It's difficult to move fast with those. It takes 45 days or a long time. I haven't done one of those in a long time. So my advice is on a house hack or something early on, as long as if you have a W-2 job, you have good income, good credit, that's a really good source to start with if you can. But I would also go to like plan B, like try to talk to private lenders, try to talk to a commercial bank, just in case you get that really hot deal that you need to move fast on. I would prefer to have the option to go buy it quickly with a commercial loan or with a private lender, fix it up, and then come back and do like a conventional loan 6 months later. And for the lingo for that, for people who've listened a lot, it's the BRRRR strategy. You buy it, you remodel it, get it rented, then you refinance it 6 months later, 4 months later, whenever you can do it.
Yeah.
It's a little bit, it's a better strategy if you're trying to buy good deals and move fast. There's a few more moving parts, but I think that's what a lot of investors choose to do.
Yeah. And something that I've done, and I'm actually helping someone do now as an agent, is utilizing owner financing to get the deal done and locked up. And then 6 months later, after you do maybe some renovations, moving in and getting a long-term. Because one of the benefits, like you mentioned, to owner financing is that you get long-term fixed rate debt, right? And so you don't have to deal with some of the, maybe fluctuations in interest rates like we had maybe pre-2007. There's still some of those. But also you get 30-year rather than a balloon like you talked about, 5 years, right. 7 years, 10 years. And so, that's something practical and tangible that people can potentially combine, which is owner financing and then long-term.
That's smart. Yeah, I like it. I hadn't thought about the owner financing BRRRR strategy. That's really cool. I like that.